So imagine for a moment that you have a trading system like Counterpunch Trader and it's time to start trading live. And this is assuming you've done all your homework and you know how to trade the system, you've back tested your trading plan, and you've been involved in the trading room, which has really built your confidence to identify and trade the system setups. You're all set to risk real money in the live markets and you begin the process of growing your trading account. Now let's be clear that if you're not ready to jump into live trading, just don't do it. The markets are not going anywhere, and you really want to protect the most vital component of your trading business, which is your capital. So before you begin, ask yourself, which market and time frame will I trade? What time does my trading day start? And what are the risk parameters I will use to protect my account? You also want to ensure you understand that trading is not a get-rich-quick scheme. Your trading account will not rocket to new highs overnight, and approaching trading with that expectation will not only leave you disappointed, but also have you risking too much and getting wiped out during a losing streak. You have to expect a 2 steps forward and a 1 step backwards progression of your equity curve while you compound your trading account. Stick to your proven trade plan and resist the urge to jump from market to market during different volatility levels. You will have a string of losing trades, and while this will challenge your resolve, review your back tests and the drawdowns that occurred during the testing, and just trust in your system. So when you did your back test, you chose the markets that you're going to consider trading, and hopefully you picked markets with a small trade profile. Markets such as the Nasdaq, Forex Minis, and the Dow are ideal for new traders. When your account begins to grow, you may want to consider giving yourself a raise, which is just adding more contracts, which will give you a bigger profile, or you may want to add another market into the mix. There is no one-size-fits-all approach. However, here are some rule-of-thumb suggestions for starting account sizes for various markets. Just pause the video here and check these out. Now, once you've doubled your trading account using responsible risk parameters, perhaps you consider adding in another contract. Now, this is when you will really start to get the benefit of compounding your profits, your trading account, to a larger size. So, for example, assume you're starting with a $10,000 account and you decide to trade the Russell. Being a responsible trader, you backtest the trading system in the time frame you're considering, and you have over 100 trades logged in your spreadsheet. Assume you see the average daily return is a point or $100, and because this is an average return, it's taken into account your drawdowns. Now, since this is an example, let's look at the best case and assume all your fees and your slippage are included, which they won't be during your back test, so keep that in mind. So you've logged about 50 trading days and your account has grown from 5,000 to 10,000, for example. You're now able to trade another contract while keeping in line your risk management protocols. Add another 5,000 and now you have 3 contracts in play. Now it only takes 25 days to get another $5,000 added to your account. It looks really exciting that you can grow your account from $5,000 to over 30,000 in about 7 months. The sky is the limit, right? And while this is possible, in the real world of trading, it's not really this simple. Your demo account trading might have gone well, but it is a lot harder when you're trading live. Your capital is real. The loss is real. And while demo trading can help perfect your trading skills, it doesn't really prepare you for the mind games that occur when you're trading live. Fear of missing out on a sure thing that will add large profits to your account will cause you to jump in late and be the buyer at the top of the move. Greed will have you pushing your trades when all signs are pointing to the exits. You will be popping out of trades and only in small profits because you're afraid of giving back anything. And during these times, you find out that trading is all about the individual. You make the decisions, and no talking head on CNBC or forums or Twitter is going to be of any help to you. It's just you and the glow of your computer monitor. That is why your trading rules are so important to any type of long-term success. If you're afraid of losing your money, it's going to affect your ability to handle trading losses. You'll be affected by the drawdowns that will come and will force you out of trading the plan that you've tested. You may jump time frames, change markets, or a number of things that's really not conducive to long-term trading success. And one thing that seems to happen to new traders is being hit by drawdowns on the very first set of trades that are placed. It's almost as if the market is giving you some left jabs to see if you have the ability to stand in the ring and trade. Well, I'm sure there are some people who have hit home runs right from the start. It would be a wise idea to expect your trades, especially in the early stages, to have a negative outcome. Expecting a loss is much easier to receive when it does happen, plus it'll force you to stick to your risk parameters. You may experience drawdowns that will set your compounding of contracts off for a number of weeks or months, which makes the original graphic obsolete. Here's a real equity curve, and while looking at it, ask yourself if you would be able to withstand that huge drop in the middle of the chart. And this is the reality of trading. What if that large drop occurred at the far left edge? What sort of thoughts would you be having? Would you change your trading system or your markets? When it looks this bad, would you still be around for that massive upswing that takes the account to new highs? Or would you have packed in your dreams of trading? Well, risk management is important. Nothing shows how important it is like the valleys that occur in your equity curve during a string of losing trades. Without trust in the system and the rules you've tested, you will step aside when the going gets tough, and you're going to miss out on the 2 steps forward part of trading. Now, in the chart, you can see where the advance has doubled, and you'd begin to add more contracts to your position sizing. Now, what's interesting is that even though the risk percentage remains the exact same, the risk in dollar terms is much higher. Taking the Russell as an example, trading 1 contract will be $10 per tick of price movement. If you're in a position to trade 6 contracts, you're looking at each tick being $60. When the losses come and your drawdowns occur during your 6 contract position sizing, 10 points of drawdown is no longer $1,000. It's $6,000. That number is going to scare some people, but by now you should know with certainty that this will probably happen during your trading career. That said, look back at the equity curve. And if you are truly trading an edge and you stick to your rules, you can bounce back from these drawdowns and watch your curve hit new equity highs. And as your account continues to grow, you can look at your risk protocols, and you may choose to reduce your risk per trade, which will enable you to better handle the higher dollar amount losses. When trading a small account, you may be looking at risk percentages of between 5 to 8 to enable you to even place a trade. In these cases, ensure you start to lower your risk percentage as your account grows. And while this may be a speed bump in your account growing process, it will certainly be much easier to take positions and the losses that are going to come. So growing your account and trading success is a simple process. You follow your rules, you backtest your trading system, and you ensure proper risk protocols. Always go back to your trade plan and your stats during those times when things get tough. Start reducing risk when you can so you can handle the losses and still be solvent when the uptick in your equity curve is about to happen. Stay disciplined and with full trust in your trading system, watch that 2 steps forward, 1 step backward advance of your equity curve, showing you a growing trading account. Now, since many traders like to use indicators, usually the wrong way, for their trading method, Netpicks has put together a free and vital indicator blueprint to put you on the right track when using an indicator for your trading decision. And you can get access to the PDF and the videos by clicking here.